Picture this for a moment. You're scrolling through your social media feed late at night, and you see yet another friend posting photos from an expensive vacation. Your neighbor just pulled into their driveway with a brand new car. Your coworker casually mentions they're renovating their kitchen for the third time. And there you are, wondering if you're the only person who actually looks at price tags before buying anything. Here's the uncomfortable truth that nobody talks about. Most of us are walking around completely blind when it comes to money. We have absolutely no idea whether we're doing well, falling behind, or somewhere in the middle of the pack. We make assumptions based on what we see around us, but what we see is usually just the highlight reel, not the full financial picture. Today, I want to change that. I'm going to show you exactly where the average person stands financially, and I promise some of these numbers will surprise you. Some might make you feel better about your situation, while others might serve as a serious wake-up call. Either way, by the end of this, you'll finally know where you really stand. My name is Jim. I make videos to help you actually understand money, personal finance, and building real wealth without the hype. If you want calm, clear explanations instead of panic and confusion, hit subscribe and stick around. And if this episode helps you see your own numbers more clearly, tap the like button so YouTube can show it to more people who need it. Think about it like this. If you wanted to get healthier, wouldn't you want to know what normal looks like? If you wanted to improve your career, wouldn't you want to understand how your skills compare to others in your field? Money works exactly the same way. When you understand the baseline, you can make informed decisions about whether you want to be average or whether you want to do something different. Money is stat 1. Income. Let's start with income, because this affects literally everyone who works. When you deposit that paycheck every 2 weeks, are you earning more or less than most people? According to recent government data, the typical full-time worker in America earns about $52,000 per year before taxes. That breaks down to roughly $26 per hour if you're working full-time. Now, before you start feeling too good or too bad about that number, remember, this is individual income, not household income. And when we say typical, we mean half of all workers earn more than this amount, and half earn less. It's right in the middle. But here's where reality hits hard. That $52,000 is before the government takes their cut. After federal taxes, state taxes, Social Security, and Medicare, depending on where you live, you might be taking home somewhere between $35,000 and $40,000. Suddenly, that doesn't seem like nearly as much money, does it? Income is just the starting point, though. What really matters is what people do with that money once they earn it. And this is where things get fascinating and honestly pretty concerning. Money stat 2. Retirement savings. Let's talk about retirement savings, because this is where a lot of people are in for a shock. The typical American has saved $65,000 for retirement. Now, before you react to that number, remember, this includes people of all ages who actually have retirement accounts. Here's the part that should keep you awake at night. About 1 in 4 Americans has exactly $0 saved for retirement. 0. That means every fourth person you meet is planning to rely entirely on Social Security when they stop working, assuming that program even survives. For those who do save for retirement, the numbers vary dramatically by age. People under 25 have saved less than $2,000. Now, if you're 23 and just starting your career, having $2,000 saved isn't terrible, but it does show how critical it is to start early. The 25 to 34 age group does slightly better with around $14,000 saved. But even that seems pretty small when you consider these are people who've been working for several years and should be hitting their financial stride. By the time people reach 65 and older, the typical balance climbs to around $88,000. While that might sound like a decent chunk of money, let's put it in perspective. If you retire with $88,000 and follow the standard withdrawal rule of taking out 4% per year, you'd get about $3,500 annually from your retirement accounts. That's less than $300 per month. $300 per month. Think about that for a second. Could you survive on $300 per month in retirement? Even if you own your home outright and have no mortgage payment, $300 wouldn't cover groceries, utilities, healthcare, and everything else you need to live. This is exactly why understanding these numbers matters so much. If you're in your 20s, 30s, or 40s, and you're looking at these retirement statistics, you should be having a serious conversation with yourself about whether you're saving enough, because clearly the average person isn't. Money stat 3. Social Security. Since so many people are planning to rely heavily on Social Security, let's examine what that actually provides. The average monthly Social Security benefit is around $1,550. That's about $18,600 per year. Now, $18,000 might sound workable, especially if you don't have a mortgage payment. But remember, this is the average. If you had years where you didn't work or earned very little, your benefit could be significantly lower. And if you never earned much during your working years, you might be looking at a Social Security check that barely keeps the lights on. Some people take a completely different approach. They plan their retirement assuming they won't receive a penny from Social Security, treating any benefit as a bonus. This might seem overly cautious, but given the long-term funding challenges facing the program, it's probably not a bad strategy. Money Stat 4. How much people actually spend. Let's shift focus to something that affects your daily life right now. Spending. How much does the average household actually spend each month? According to government data, American households spend about $5,577 per month. Over the course of a year, that adds up to roughly $67,000 in total spending. Think about what this means. If the average household spends $67,000 per year, they need to bring home at least that much just to break even. And remember, we're talking about take-home pay here, not gross income. So if you want any money left over for savings, investments, or building wealth, you need to earn significantly more than $67,000 per year as a household. This spending breaks down into predictable categories, but the amounts might surprise you. The biggest chunk goes to housing, which shouldn't shock anyone who's ever paid rent or a mortgage. The average household spends about $1,885 per month on housing costs. That includes rent or mortgage payments, property taxes, insurance, utilities, and maintenance. $1,885 per month on housing. That's over $22,000 per year just to keep a roof over your head. And if you're living in a major city, you're probably laughing at how low that number sounds. In places like San Francisco or New York, $1,800 might get you a closet with a window if you're lucky. Food comes in as the second biggest expense, with the average household spending about $691 per month on groceries and dining out. That's over $8,000 per year just to keep everyone fed. Honestly, if you're spending less than $700 a month feeding your family, you're probably doing something right. Transportation eats up another $913 per month, covering car payments, insurance, gas, maintenance, and public transportation. Nearly $11,000 per year just to get from point A to point B. This is why some financial experts suggest that your housing and transportation costs combined shouldn't exceed 50% of your income. When you add up that $1,800 for housing and $900 for transportation, you're already at $2,700 per month. And we haven't even talked about anything else yet. Money Stat 5. Credit scores and credit card debt. Now let's dive into something that can make or break your financial future. Credit scores. Most people know they should care about their credit score, but they might not know where they actually stand compared to everyone else. The average credit score in America is 715, which is actually pretty solid. Credit scores range from 300 to 850, so 715 puts the average person in what's considered good credit territory. This number tells us that a lot of people are doing at least some things right when it comes to managing their credit. They're generally paying their bills on time and keeping their debt levels reasonable. But don't let that 715 average fool you into thinking everyone has their credit situation figured out. There are still plenty of people walking around with scores in the 500s and 600s, wondering why they can't get approved for decent interest rates on anything. Your credit score affects everything from your mortgage rate to your car loan terms. Even some employers check credit scores before hiring. The good news is that maintaining a decent credit score isn't complicated. Pay your bills on time, don't max out your credit cards, and avoid opening new credit accounts every time you want to save 10% at the checkout counter. Really is that simple. But somehow a significant portion of the population still manages to mess it up. Speaking of credit, let's talk about the elephant in the room. Credit card debt. This is where things get ugly fast. The average household is carrying over $9,000 in credit card debt. $9,000. That's not a car loan or a mortgage where you're buying something that holds value. That's $9,000 spent on stuff that's probably sitting in closets gathering dust or already thrown away. What makes this even more painful is the interest rates on credit cards. We're talking 15, 20, sometimes 25% or higher. If you're paying 20% interest on $9,000 in credit card debt, you're throwing away $1,800 per year just in interest payments. That's money that could be going toward building wealth, but instead it's making credit card companies rich. Here's what really bothers me about credit card debt. Most of it comes from buying things people don't actually need. Sure, sometimes people use credit cards for emergencies or unexpected expenses, but let's be honest. A lot of that $9,000 went toward clothes, electronics, dinners out, online shopping sprees, and impulse purchases that seemed like a good idea at the time. The solution's straightforward, even if it's not always easy to implement. Pay off your credit card balances in full every single month. If you can't afford to pay cash for something, don't put it on a credit card unless it's a genuine emergency. And if you're already carrying a balance, make paying it off your top financial priority, even before you start investing for retirement. There's no point earning 7% in the stock market if you're paying 20% on credit card debt. Money Stat 6. Net worth and savings rate. Now let's talk about net worth, which is probably the best single number for measuring your overall financial health. Net worth is simply what you own minus what you owe. Add up the value of your house, your cars, your bank accounts, your retirement accounts, and everything else you own. Then subtract your mortgage, credit card debt, student loans, and any other money you owe. Whatever's left is your net worth. The typical net worth for American households is about $122,000. But just like with retirement savings, this number varies dramatically by age, and some of the breakdowns are pretty eye-opening. If you're under 35, the typical net worth is less than $14,000. Now, if you're 25 years old and just starting your career, having $14,000 in net worth isn't terrible. But if you're 34 and still sitting at $14,000, you might want to have a serious conversation with yourself about your financial trajectory. The 35 to 44 age group does better with a typical net worth of $91,000. The 45 to 54 crowd hits $168,000. People between 55 and 64 have a typical net worth of $212,000, and those 65 to 74 years old hit $266,000. Here's what I find fascinating about these numbers. They're actually pretty achievable for most people with decent incomes and some basic financial discipline. You don't need to be a stock market genius or start the next big tech company to hit these milestones. You just need to consistently spend less than you earn and invest the difference. But there's another side to this equation we need to address. Savings rates. How much of their income is the average person actually setting aside? Americans save about 6% of their income after taxes. 6%. That's it. Now, 6% might not sound terrible, but let's think about what this really means. If you're saving 6% of your income, and some of that needs to go towards short-term goals like buying a car or making a down payment on a house, there's not much left over for long-term wealth building. Consider this. The average down payment on a home is $62,000. The average kitchen renovation costs $26,000. A new car averages over $47,000. If you're only saving 6% of your income and you need to fund all these shorter-term goals, how much is actually making it into your retirement accounts? Most financial experts suggest saving at least 10 to 15% of your income specifically for retirement. And that's on top of whatever you're setting aside for other goals. If you want to retire early and not work until you're 70, you probably need to be saving even more than that. Money Stat 7. Retirement age and time. This brings us to something that might surprise you. Retirement age. When do you think most people actually stop working? If you guess 65, you'd be close, but not quite right. The average retirement age in America is 61. Now, that might sound pretty good at first. Who wouldn't want to retire at 61 and spend their golden years doing whatever they want? But here's the catch. Most people can't collect their full Social Security benefits until age 67. So if you're retiring at 61, you've got 6 years to bridge that gap somehow. And if your retirement savings look anything like those typical numbers we talked about earlier, those 6 years might be pretty lean. Here's another way to think about it. If you start working at 22 and retire at 61, you've been in the workforce for 39 years. That's nearly 4 decades of getting up early, commuting to work, dealing with bosses, sitting in meetings, and doing whatever you do to earn a paycheck. After all that time, you finally get to retire with maybe $88,000 in your retirement account, which gives you about $300 per month to live on. Does that sound like a good deal to you? Because honestly, it sounds like a pretty raw deal to me. But here's where it gets even more interesting. Government data shows that someone who reaches age 65 can expect to live another 19 to 21 years. So if you retire at 61, you might have 25 years or more of retirement to fund. 25 years is a long time. That's longer than most people's entire career up to that point. And here's the question that should keep you up at night. How many of those 25 retirement years are you going to be healthy enough to actually enjoy? At 61, there's a decent chance you're still in good shape. But what about at 71 or 81? Time has a funny way of catching up with all of us. The activities you can do at 65 might not be the same ones you can handle at 75. This is why understanding these financial statistics isn't just about satisfying curiosity. It's about recognizing that the average person's approach to money isn't working very well. When the typical American has less than $90,000 saved for retirement and is carrying $9,000 in credit card debt, something is seriously wrong with the picture. What to actually do with these stats? But here's the good news, and this is why I wanted to share all these numbers with you. Once you know what average looks like, it becomes pretty clear how to do better than average. And doing better than average doesn't require some magical formula or secret knowledge that only wealthy people possess. If you consistently save more than 6% of your income, you're already ahead of most people. If you avoid credit card debt or aggressively pay it down if you already have it, you're way ahead of the game. If you understand what you're investing in and you're actually putting money into retirement accounts on a regular basis, you're lapping the competition. Think about it this way. If the average household is spending $5,500 per month and you can figure out how to live comfortably on $4,500 per month, you've just freed up $12,000 per year for savings and investments. Do that consistently for a few decades, and you'll be in a completely different financial league than most of your peers. The same principle applies to all of these statistics. Beat the average by a little bit in multiple areas, and the compound effect over time becomes massive. Earn a bit more than $52,000 per year, save more than 6%, avoid credit card debt, and invest consistently in low-cost index funds, and you'll retire with significantly more than $88,000. What I find most interesting about all of this is how these numbers reveal the gap between what people say they want and what they actually do. Everyone says they want financial security. Everyone says they want to retire comfortably. Everyone says they want to stop worrying about money. But the average person's behavior doesn't match up with these goals. Maybe that's because most people don't actually know what average looks like. Maybe they assume everyone else has their financial act together, so they don't feel any urgency to change their own habits. Or maybe they know they should be doing better, but they don't know where to start. Or they think it's too late to make a difference. If you're watching this and some of these statistics hit a little too close to home, don't panic. The fact that you're here learning about money and trying to understand your financial situation already puts you ahead of a lot of people. Most folks never even take the time to figure out where they stand or what they need to do differently. The key is to use these numbers as motivation, not as an excuse to give up. If you're 35 with less than $14,000 in net worth, that doesn't mean you're doomed to financial mediocrity. It means you have some work to do, but you also have 30 years or more to get it right. And if you're already doing better than these averages in some areas, don't let that success make you complacent. Maybe you have a solid credit score and no credit card debt, but your retirement savings are behind. Or maybe you're great at saving money, but you're keeping it all in a savings account, earning practically nothing instead of investing it for growth. The bottom line is this. These financial statistics of the average person should be eye-opening, but they should also be empowering. When you know what normal looks like, you can make informed decisions about whether you want to be normal or whether you want to be better than that. Personally, I think you deserve better than retiring at 61 with $88,000 and hoping Social Security doesn't run out of money. You deserve better than carrying credit card debt and spending every dollar you earn. You deserve the peace of mind that comes with having your financial house in order. These statistics show us where the average person ends up, but they don't have to define where you end up. Use them as a starting point, not a finish line. Because once you understand what most people are doing with their money, it becomes pretty clear how to do something different and get much better results. The choice is entirely yours.